Wall Street has come a long way since the meltdown of 2008. So what do we have to look forward to in the new year? Financial advisor Mark Agel is here. So 2008 was a rough year for a lot of people, a lot of businesses, and the last 6 years or so have been a very steady incline.
It's looked like a big check mark, basically, Kelly. 2008 was the worst market since 1929. No sugarcoating it. Pretty bad on all accounts, for just about everything. Since then, though, it's been a pretty straight-up recovery. So it's been a nice, long time frame. And it's great in a new year to kind of look back and reflect and get that perspective, because looking forward into 2015, we're not in the prediction, business, but it's certainly nice to reflect back and see what might be coming down the pike. And that can help investors make sure that they're not overreacting or underreacting and focusing on the right things.
What are the benchmarks of a good year? I mean, job recovery and those kinds of things that we look at to measure progress?
Yeah, those are certainly economic indicators. Forward and backward-looking indicators are certainly very helpful in that regard. We're looking at a number of different things along there. There's a couple big themes at play, basically. The ECB, European Central Bank, versus the Fed, there's going to be a divergence there. Will the Fed start raising rates when ECB is cutting for liquidity? There's a good fight going between the U.S. frackers and OPEC in terms of oil. They're trying to push the price low enough so it's not profitable anymore. Will China keep their growth engine going? There's a number of interesting themes. The good news is most of them aren't the other shoe to drop for the U.S. market. So how they play out really only is beneficial. It's a question in what way.
We keep hearing about the other shoe dropping, and we've heard about gas prices. While they seem great at the pump, the long-term implication is kind of scary. What do you think about that?
Yeah, it's interesting because we're in a closed environment, right? What comes out of savings from one person is a lost paycheck for another. So we've already seen that in the markets. A lot of the big energy companies have really taken a hit in the market, and that's kind of pushed the broad indexes lower in the past few days as the price of oil has plummeted. The backside to that is that people are paying less at the pump. That puts more money in consumers' hands. They spend more. So that's kind of the reverse cycle there. But that takes a little time to work into GDP, where ExxonMobil's share price, it gets priced in immediately. So it becomes a different matter there.
Let's talk about retirement plans.
Yep.
What's new for 2015? Anything?
Yeah, a couple things. The numbers are different, so it's important to keep on top of that, both in the New York State estate tax, so estate planning's relevant there. Also, how much you can put away towards 401ks and IRAs, those numbers have gone up, so it's important to keep on track of that. Probably the most important thing to keep in track coming up is perspective. Last year was a dangerous year in that most equities went up, but a lot of things didn't. It did not pay to diversify. And that's a lesson you don't want reinforced. It only happens once, twice a decade.
But you always hear diversify is the best way to make the most money.
80–90% of the time that's true. Last year it wasn't. Don't learn from that. Keep diversified.
All right. Thanks, Mark.